Hello, greetings, and welcome to Dividend Blasters. This is our 49th video. Our topic today is our national debt. What does this mean to you as a citizen and as an investor? The purpose of this video is to talk about the national debt and inflation and what it means to you and what you as an investor can do to protect yourself against inflation. Our assertion is this: U.S. national debt and inflation have a significant impact on our standard of living, and it should impact your investment strategy. We have seen the national debt go up year after year. Every year, the government runs federal budget deficits that basically show that we're spending more than we're taking in. But yet we go on with our lives. We go to work. We continue to save. We continue to invest. But what is the impact of this? Well, that's what I'm going to talk about. Right now, behind the scenes, this is what's going on. The government's borrowing. They're financing deficits through issuing treasury securities. They're also printing money. And when you are the world's reserve currency, you can do that. And we've done it for years. We've done it a lot since 2008, but we've actually done it before that, really since we got off the gold standard. And it's been going on. And when you have low interest rates, you can get away with that. But when interest rates go up, it becomes a little bit more problematic. We're going to talk a little bit about that. But before we do, a disclaimer: I'm not a financial advisor. Anything I say should not be taken as financial advice. Purpose of this video is for information and education. It reflects my own personal opinions, my research, my years as a student, as a young man many years ago, of finance and economics, and my own experience as an independent investor for more than 30 years. However, I urge you, do your own research, your own due diligence, and consult a financial advisor prior to making any financial decisions. I will also thank you for joining us here. I would ask you to kindly give us a like. And at the end of the video, if you feel so inclined, subscribe to our channel here at Dividend Blasters and share this video with a friend or a family member. Okay, quick terminology. What is the national debt? Well, the national debt is the debt owed by our federal government to U.S. Treasury security holders. The way it works is this: the government spends money, and when they don't have enough tax revenues coming in to cover their spending, they borrow. How do they borrow? They issue Treasury securities to investors. So we, the people, the government, are borrowing from those investors, and as a result, have to pay them interest. Okay, they need a rate of return, like all of us investors want rates of return in our investments. The national debt at any point in time is the face value of any and all outstanding Treasury securities that have been issued by our Treasury. Let's add some more terminology: the annual deficit and the annual surplus. So, any time in a budget year that our federal government is spending more than it's taking in, they are running a budget deficit. And when they run a deficit, the national debt increases. And this is when our government has to borrow from investors. And they're doing this by issuing treasury securities to fund this budget deficit. And that's been the case for really the better part of our modern history. In a surplus year, and this has only happened 4 years in a row back in the 1990s, um, it's really when we are taking in more tax revenue than we are spending in our operational budget. And so when that happens, we are actually able to reduce our national debt. As I mentioned, this happened 4 years in a row back in the 1990s, and we're actually able to retire, I want to say, I don't know, around $1 trillion, maybe a little less. But that has been a long time. Hasn't happened in a while. Every time we run a federal budget deficit, the national debt increases. National debt is the accumulation of all federal budget deficits in our history. Now, I'm going to direct your attention to a wonderful resource. It's the Peter G. Peterson Foundation. Peter Peterson was a investment banker and a hedge fund founder. He founded the Blackstone Group back in the 1970s. He was also a cabinet member, Secretary of Commerce, I want to say, in the Nixon administration. He was always very concerned about the national debt, and he founded this foundation to bring more attention to the ballooning national debt. You can go to his website. It's a wonderful resource. There's all sorts of great information, and the address is below. It's pgpf.org, the Peter G. Peterson Foundation. I do leverage a lot of information from his website. I read his book back in the 90s, and I am a close follower of his website. He did pass away back in 2018, but the foundation is going strong. And you can read this at your convenience. Lots of great information. The meat of this discussion really revolves around the national debt. And I will tell you that the national debt as of today is around $32.6 trillion. It increases about $8,000 a second. And that translates to about $97,500 per person in the United States. That is not chump change. That's a lot of money. You can see from this graphic the trending of the national debt as it relates to GDP. And back around World War II, you can actually see that the national debt exceeded 100% of GDP. And then it precipitously declined in the post war years. And back in the 1960s and 70s, it came down and it was in the 30% range. And then it started to go up in the 80s, as we increased our defense spending. And then, of course, um, entitlements really increased. We were having issues with maintaining the solvency of the Social Security and Medicare trust funds. And we had to do some quick work around that. And then you could see it actually come down in the early 2000s. And then probably around 2008, 2009, really after 9/11, where we grew government. And, we grew it with Department of Homeland Security. We also increased our defense spending. We went into a real defense posture. We financed a couple of wars in the Middle East. And then we had a change in administration, and we had more government programs like the National Health Care Act, the Affordable Health Care Act, I'm sorry. And that has increased, and it's continued to increase. We had COVID and the pandemic, and there were several stimulus programs where we saw government spending continuing to increase. So you can see in the late 20 teens, the ratio of national debt to GDP continues to go up, up, up over 90%. And right now it's around 90, I want to say 96 or 98% of GDP. And the expectation that if it continues on this trend, that by the year 2063, it's going to be 196%. That is not good. That is too much debt, and it's probably not sustainable. So that's why I want to bring this to your attention. A lot of people don't talk about it. It is not a comfortable topic to discuss. So let's talk about what's driving the national debt. Well, there's a handful of issues. One is demographics. The country is aging. Our largest segment of our population are the baby boomers, and they are beginning to retire, and they are turning 65 every day at the rate of 10,000 people a day. And that is expected to continue through 2029. And they're living longer. Not a bad thing. That's a good thing. But it's expensive. And what's happening is that the workforce is shrinking and the retirees are increasing. And so that is a demographic problem. It's putting a strain on the budget because Social Security costs, Medicare costs, Medicaid costs are all going to increase because more senior citizens are going to be drawing on these programs, and we need more workers to pay into the system to pay taxes to support this. That is a problem. And you can see the trend of the number of seniors. In 2020, it was 56.1 million. We're probably around 60 million right now. And at the current rate, we expect that by 2060, it'll be almost 95 million senior citizens. That is a lot of seniors. What's another driver? Another driver is rising healthcare costs, not just for seniors, but for everybody, but particularly for seniors. Look at the comparison of healthcare costs in the United States versus everybody else in the industrialized world. Okay, per capita annually, it's $12,318 in the United States. It's almost double Germany, which is the next most expensive, almost 7,400. Then below that is Switzerland, then Austria, and you're in the sixes. South Korea is 3,900. So we're paying a lot for healthcare in the United States, but we're not getting enough benefit out of it. That is a problem. Another driver. Well, and it's kind of obvious. I talked about the deficit, and that the problem is that there's a structural problem in our budget process. And the problem is that revenues, tax revenues, are not sufficient enough to cover spending. And I am not saying we should raise taxes. No, taxes are too high. We need to get spending under control. Spending is too high. This government is spending too much money. We need to cut spending. That's just my opinion. And you know what? Folks are going to agree. Folks are going to disagree. That's fine. But I'm sharing with you my position on this. You can see that from the Congressional Budget Office, they're projecting spending to continue to separate from revenues, and the gap is going to grow. And the red line is going way, way up. Well, the blue line, red line spending, the blue line is revenues. While spending is increasing, revenues are flat. And that gap is projected future budget deficits. That is going to continue to add to the national debt. So, what is the national debt costing us? Well, it cost us in interest payments on these treasury securities that we're issuing to investors to finance these budget deficits. And on average, we're spending $1.8 billion a day on interest. What does that translate to a year? That's about $730 billion a year just on interest. We're not even getting anything back for that. It's just basically to maintain these investors' positions who have lent their money to finance our spending imbalance. That's all that is. Interest is the fastest growing part of our federal budget. In 10 years, it's going to triple from where it is today. And you know, the problem here is that interest has the result impact of crowding out other important government spending programs like infrastructure, bridges, roads, you know, technology investments. I mean, there's been some legislation passed to uh, help our semiconductor manufacturers in this country and to help build, plants. Some people may think that that's not a good idea, but you know what? It can't hurt um, our producers of all important semiconductor chips. Well, stuff like that could get crowded out through interest on the national debt. That is not good. And it's better to have less debt and have less interest on the debt than it is to have more. So, what is the linkage between our national debt and inflation? We may not necessarily feel the impact of the national debt, but we do feel the impact of inflation, and they are related. And how are they related? They're related this way. When we increase debt in our country, government debt, and there's not a corresponding increase in something productive, okay, like demand or income, GDP, what's going to happen is you're going to have an increase in prices, okay, or inflation. That's what that is. And you're probably at some point going to have an increase in interest rates. That's where the Fed gets involved. Let me say that again. The second bullet sums it up nicely. A continuing issuance of debt not met by a continuing growth in the demand for debt is going to show up as a higher rate of inflation. You got to think about that. But basically, there is no such thing as a free lunch. Okay. Free money is just not real money. It's really not. It's devalued money. And then you're going to get inflation. When you get inflation, you get a devalued currency. And I'm going to get into that a little bit more. Let's talk more about inflation, other ways to define it. But in sum, it's basically an increase in the general price of goods and services. When price levels increase, every currency unit that you have buys fewer goods and services. So, what does that mean for us? That means your dollar buys less. So, when you go to the grocery store and there's a 10% increase in the cost of eggs, guess what? What used to cost, and I'm just saying, what used to cost $1 is now going to cost $1.10. Same thing with milk, same thing with steak, with chicken, same thing when you go to the gas station. We've seen it when we go and buy gas for our cars. We want to fill up the tanks. We've seen the price of oil. The price of a barrel of crude oil has gone up. Well, there's been inflationary pressures that have been applied to the oil and gas sector, and we've seen that. And how do we measure all this? We measure this through the consumer price index, and we see this through our Bureau of Labor Statistics. They provide that measure. We track it closely. Here's a historical graph that shows the fluctuations of inflation since really the 1930s. You can see how it really spiked up during World War II, and then it came down precipitously. And then it started to go back up in the 1970s. You remember the years of maybe, before your time, but I remember I was a kid. Remember the years of stagflation and increased gas prices and gas lines and OPEC and our dependence on foreign oil and all this stuff was kind of coming together. It was a confluence of events. It was driving up inflation. And, as a result, we had to increase interest rates. And we had a chairman of the Federal Reserve, Paul Volcker, who took what I would feel is a very courageous stand. It was painful for everybody, but he raised interest rates significantly to drive and wring inflation out of our economy, to wring all of that excess liquidity or excess dollars that were in the economy out. So then you can see that really throughout the 1980s and the 90s and the 2000s, and inflation was very much under control, under 5%. And then, really after 2020, there's really just changing government policy, more spending. Um, we had COVID, and there were a lot of stimulus packages, spending packages that were passed to take care of people that couldn't, you couldn't really go out because we were all under quarantine. And people were like, "How am I going to pay my bills? I got to work." So a lot of government payments going out, and also the government was printing money. So not only were we um, issuing treasury securities to finance these deficits to pay for these, our Federal Reserve was also issuing dollars. They were printing money. The printing presses were running. And so you hit all this excess liquidity into the system, and you get inflation when that happens. And basically, in a sum of what I just said a few minutes ago, you had too many dollars chasing too few goods and services. Then you get inflation. Here's a closer look. at the trend of inflation just over the last 2 or 3 years, you can really see how it spikes up, probably in the 2020, 2021 time frame. And it continues to spike up really into, late 2022. And, let me just say this as a backdrop. Remember what happened to us investors in 2022? The stock market really didn't do well. A lot of people were skittish about investing in equities. And with rising interest rates, and that's what happened basically as a result of this inflation. The Federal Reserve did start to course correct all of the money printing. They started to basically say, hey, we got to raise interest rates. And they've been raising interest rates for the better part of a year, year and a half, to combat all of this excess liquidity that's in the markets. And as a result, people were skittish about what was going on in the stock market. They started pulling out, and stock performance was not very good in 2022. It was a bad year. And even the beginning of 2023, it was a bad year. Now you can see inflation's coming down, and it's like, wow, the market's starting to rebound, especially the tech sector has been doing very well. And in some of the consumer um, staples and sectors also doing well. A handful of sectors are doing better. So we're starting to see maybe the tail end of inflation, but I don't think we're through this. I think we're going to see more rate increases. I think we're going to see at least one more. That's what I've been hearing. So let's kind of cut to the chase. We talk about the symptoms of inflation, but what really causes it? Well, it's really the growth rate of the money supply. And who controls the money supply? The government. Okay, the government spends money through fiscal policy. The government changes the money supply through monetary policy. They adjust interest rates. They print money. So when the Federal Reserve, prints money, they got the printing press going, or they lower interest rates, or they keep cheap money. They keep the price of money very cheap. And for several years since 2008, the price of money was very, very cheap. And they continued to print money. And you had a lot of excess liquidity building up. And then last couple of years with COVID, you could see fiscal policy coupling with that with lots of stimulus programs, especially around COVID. And so that's basically what's been happening. And we call this change in the rate of the money supply the quantitative theory of money. So I did talk about the Federal Reserve. They're located right there in Washington, D.C. They are really a quasi independent agency. They control the money supply. And when they want to get those printing presses going, they print more money and they lower interest rates. If you are in a recession, you need to do that, but you need to manage it carefully. You can't overdo it because you will have a problem with inflation. And when you have inflation, you don't want to risk hyperinflation and really overly devaluing your currency. It's not a good thing for anybody. So, what are some of the general effects of inflation? They affect different sectors of the economy differently. So, I would say in the short term, if you own a physical asset like a home, real property, if you own stock, you're probably going to benefit from increased prices and values. They're going to go up. Your value of your holdings are going to go up because prices are going to go up. But who's it going to hurt? It's going to hurt the people that don't have those things. It's going to hurt the people who want to buy those things, and they're going to try to buy them with dollars that are being inflated or devalued, I should say, through inflation. That's a problem. It's going to be a problem for pensioners, people that are living on fixed income. That's a problem. It's going to hurt salaried workers. Sometimes companies don't necessarily take inflation into account. Maybe they can't afford it or they don't want to. And when they do address it, they take their time. So, salaried workers, that's a problem. Anybody holding cash in a low paying savings account, they're going to have a problem. If you have 7 or 8% inflation and you have a savings account that's paying you 1 or 2%, you're losing money. You're losing 5, 6%. You need to get your money out of there. You need to seek a higher rate of return. Otherwise, your money is just going to evaporate. Other negative effects, well, businesses. They will have problems planning around the unpredictability of high inflation rates. They may not know how to budget or plan, especially if you have folks that are seeing that they are not getting paid at a rate commensurate to keep in pace with inflation. That is problematic. They may look for another job, and the company may not be able to afford new staff. They may have to cut staff. And as a result, they may have to focus less on productivity. They may have less people. They may have less capital to deliver output. And they may have to just focus on profits and losses. So they may need to cut more staff. They may lose staff. They may need to cut staff. So that's a problem. Uh, Consumers, if they have uncertainty about the value of their currency, it's a disincentive to save. Okay, especially in a low interest savings account. They're going to hopefully look for higher rates of return, maybe in a high yield savings account. And I did a video on that several months ago. Or maybe a fixed income instrument that pays more, but it's going to tie your money up more. Like a CD or a treasury security. So that's a problem. You know what? Outside of the short term, uh, you're probably going to have the Federal Reserve or the central bank start to say, hey, we got to do something about this inflation. We got to raise interest rates. And what's going to happen is if you are a stock investor, you're going to see the impact of that on your investments. They're probably going to be adversely affected as people start to pull out of the market and look for a safe haven, like in a high yield account or a CD or a treasury security or a corporate bond. That's what's going to happen. Inflation is essentially a tax on your earnings. It's a tax on your wealth. It really is because you're able to buy less than you were before. Nothing's changed. The only thing that has changed is the value of your dollar. Okay? It is a tax. And it's a redistribution of wealth, and it's a redistribution of purchasing power. It's a redistribution from those who may be on a fixed income, like a pensioner. And maybe their pension is not indexed to inflation. Maybe it's fixed. So their pension's going to pay for less of their expenses. Uh, where's this redistribution going to go to? It's going to go to somebody who may have a variable income or a really high income. They're not going to feel inflation. The super wealthy, the 1/10 of 1%, or somebody who may have a living off investments that are indexed against inflation. There are some ETFs out there that are indexed against inflation. So anyway, that's something. Also, this can have an impact on international trade. Uh, One country has higher inflation than another, and they're exporting to another country. That country that's importing is going to pay a higher price. They're going to be impacted by that inflation. There's a ripple effect there. There's social unrest that can happen. There can be massive demonstrations, revolutions. People are starving. They're not going to be happy about that if they can't put food on the table, if they can't support their family. They're going to hold somebody accountable. They're going to hold the government accountable. We saw this back in 2010 and 2011, back in Egypt and in Tunisia. There were a couple of heads of state that were really deposed. Hosni Mubarak of Egypt and the Tunisian president, and I'm not even going to pronounce his name, but you can see it there. He was ousted, and it was really because of demonstrations against inflation and other things. It's a complex issue. I'm going to talk a little bit about hyperinflation. Now, we in the United States do not have hyperinflation. Hyperinflation is when you have an inflation rate of maybe 500 or 600%, and that's just an absolute disaster. That's where your currency does not hold any value. It's probably decreasing in value by the hour. Um, it's just not it's not good. Ours, was probably close to 10%, and it's coming down. And it's been higher. And you know what? 10% isn't comfortable, especially if you live paycheck to paycheck. But if inflation becomes too high, like hyperinflation, people are not going to use the currency. They're going to use other means to buy and sell goods and services. They're probably going to barter. They're going to find other ways um, to support themselves. It's going to have an impact on the supply chain. We've actually talked about the impact on our supply chain, and that's just with inflation, not hyperinflation. Um, let me say another thing, and I'm going to get into this a little bit more. Um, with our inflation and our debt, some countries um that have become very dependent on the U.S. dollar, and the U.S. dollar is the world's reserve currency, and it's a currency that most countries do business in. Um, there was, I will say this: there were some sanctions on Russia after Russia invaded the Ukraine, where we froze some of their assets, their dollar assets. They got a little skittish, and they have been banding together with some other countries to come up with their own basket currency to rival the U.S. dollar. It's called BRICS, and it's Brazil, Russia, India, China, and South Africa. So that has been an impact. Uh, and I will just say this here, that it's really not, in my judgment, a threat or considered what I would call a rival or would be a rival to the US dollar, but it is an impact. There are countries that are looking to do this. So that's a negative effect of inflation and maybe some public policy that could be better thought out. And I talked about hyperinflation, 500 to 600%, and that's really catastrophic. We don't have that here, of course. How do governments control inflation? I did allude to this a few slides ago. That basically it's monetary policy enacted by a central bank. They're looking to control either interest rates, the cost of capital, by raising them and getting money out of the system. Uh, or just getting money out of the system. That's really the way they do it. The opposite is getting money into the system, lowering interest rates, or printing money. So that's how they control inflation, is to get it out of the system by raising interest rates. And we've seen the Federal Reserve do this for the past, I want to say, year and a half. There's been maybe 8 or 9 interest rate hikes, and it's been uh, not great for equities investors. We've seen the stock market in 2022 really perform poorly. And if you had money in the stock market, like most of us do, uh, it went down. But if you're a dividend investor, you're less impacted by that. But still, you want to see your investments perform well. So anyway, that was the impact of that. Um, and just here's an example. I want to mention that back in the early '80s, where inflation was very high. The chairman of the Federal Reserve back then, Paul Volcker, who I thought was quite courageous, uh, raised the federal funds rates several times, getting them up, I want to say 15%. And he reduced the quantity of US dollars probably by 700 or 800 billion dollars. That's a lot of money. And especially back in 1980, that was a huge amount of money. And that's how we got rid of inflation. And if you recall the graphs I showed you, you can see how the rate of inflation precipitously came down in the '80s. And here is a graphic that shows the federal funds rates and how it was up over 18% probably in 1980, 1981, and how it precipitously came down in the '80s and really stayed down. Stayed down. It did go up a little bit back in 2007, 2008, came right down after that, with, basically Fed policy of very low interest rates, almost zero interest rates, a very low cost of capital. But then you can see how it's been coming back up, and now it's going back down a little bit. So something we're watching. So let me go ahead and just reemphasize this. We do not have hyperinflation. We do not have 500% inflation here in the US, but we have, 8 or 9%. It's coming down. We do have inflation. In my judgment, interest rates are still too high. Okay, it's not perfect. This is going to take a while to fix. We need to have lower interest rates. We do have, I'm going to get back to the debt. We do have a problem with a ballooning national debt. And as a result, we need to fix our structural spending problem. We can't keep running these deficits that are hundreds of billions and in some cases in recent years over $1 trillion a year. We got to lower those. We got to get our spending under control. uh, we still have and we will continue to have problems with demographics. The population is aging. It's going to age. There's nothing we can do about that. But we need to do something about the workforce. We need to increase the workforce so we can increase the tax base so they can pay into the system to support the aging population as they draw on Social Security and Medicare. What's been the impact on investors? Well, increased interest rates, as I mentioned, have sent investors really away from equities in 2022 to fixed income, fixed rate investments. We talked about high yield savings accounts, certificates of deposits, treasury securities, corporate bonds, anything to offer a safer, more fixed rate of return. Um, and I'll tell you another spillover effect is that some investors have been questioning the strength of the U.S. dollar, and they've been looking for alternatives. Some investors have been thinking, what's going on with the dollar? What's going on with BRICS? This is troubling. We've got inflation. Maybe I should invest in gold and silver, physical gold, physical silver, or maybe I should invest in cryptocurrency like Bitcoin or Ethereum. And that has been an impact. More gold and silver, probably less in the cryptos, but it's been happening. I do want to say one thing about BRICS. I think I mentioned this. It's really uh, not in my lifetime or in our lifetime going to rival the US dollar. The US dollar will probably diminish in influence around the world. It will be, in my judgment, the world's reserve currency for many, many years to come. And that is not going to change anytime soon. But however, I do think you're going to see an increase in the use of alternative assets like the use of physical gold and silver. And these are really, in my judgment, they're really less investments, they're really more insurance, but they're considered an international currency by many. Um, Cryptocurrencies are currencies, but they're not controlled by any central bank. They're decentralized. They're controlled by the blockchain. They are considered trustless. So they're very difficult to cheat on. You can't inflate them by increasing the number of Bitcoin, for instance. Bitcoin is limited to 21 million in total, no more. So that will be the case. So that holds some appeal for some investors. I personally, I have some physical gold and silver. I don't have a lot. I've got a little bit. I've got a little bit of Bitcoin, a little bit of Ethereum. I look at these as hedges, and I think it's smart to have options. That's what I do. But that's been the impact on investors. People are looking for alternatives. So, what do we need first as citizens? Well, we need stability. Okay, we need to have a stable economic and political system. We need to have a stable social fabric in the country. Okay, the federal government, first and foremost, needs to spend less. We need to live within our means. Okay, when I say we, I'm talking about the government. Okay. And when I say spend less, I mean spend less and tax less. Bring taxes down, but get spending under control. And we need to reduce the level of the national debt relative to our GDP. Can't have it over 100%. That's not good. It's got to be way under. We got to get it down below 75% um, to a more sustainable level. Okay. How do we do this? Well, we got to increase our tax base. We got to increase the workforce. How do we do that? Well, we got to increase jobs. We got to increase more businesses. We got to attract foreign and direct investment. I'm touching on all of these here. Okay. And so by attracting more investment, we're going to attract more businesses. You're going to create more jobs. Create more jobs. You're going to have more taxpayers. They're going to spend more. They're going to contribute more to the country and to the tax base. Uh, we, as a result, will then need to borrow less. We'll be able to reduce interest rates. It's going to be good for the economy. That is also going to be good for shoring up the value of the US dollar. Now, while we do abuse our dollar through national debt, uh, ballooning, and deficit spending, uh, the silver lining inside the cloud is that we're really better off than every other country with regards to our currency because their currencies are worse than ours. So, if there's a silver lining in the cloud, that's it. What can we do as investors? Well, we can continue to save and invest. We individually have to live within our means. Okay, we shouldn't spend what we don't have. Save your money, have an emergency fund, have a nest egg, and then invest. Invest, invest, invest. Invest in dividend investments, whether they're dividend yield or dividend income or dividend growth investments, as well as growth investments. You want to get that higher rate of return. Okay. Yeah. Don't necessarily not invest in something if it doesn't pay a dividend, because there are some really good investments that maybe they will pay a dividend one day. And you want to definitely be attached to something that is going to grow. Always, always look for a investment that has a greater rate of return than inflation. Never accept an investment that has a lower rate of return than inflation. For example, as a dividend investor, if you get wind that your holdings, your investment are going to cut their dividend, I'd cut them loose. Look for something else. You want a growing dividend. Don't keep cash in a low interest savings account. Okay? If you have to, just for, day-to-day stuff, fine, but you want that higher rate of return. Look for a high yield savings account, look for CDs, uh, look for treasury securities, and then also invest in stocks, invest in ETFs that are going to pay dividends and give you growth. Pursue alternative investments, diversify. I talked about physical gold and silver. Not really an investment, it's insurance. Okay, and they will hold value. And also consider consider cryptocurrencies like Bitcoin. We have seen Bitcoin increase in value over 80% since the beginning of the year. It is coming back, and it's really coming back since that amazing hedge fund BlackRock has announced that they are interested and have applied with the SEC to issue a Bitcoin ETF. We've seen the price of Bitcoin to continue to go up. It's come down a little bit in the last couple of weeks, but it's really way, way, way up since the beginning of the year. I will tell you that that is a good opportunity to consider. Invest in BlackRock and or invest in the BlackRock ETF for Bitcoin. And when that's coming out, I don't know. It's still under review by the SEC. But BlackRock has a record second to none as far as getting their ETFs approved. And folks, that is everything I have. I do hope you found this video to be informative and enjoyable. And I'd kindly ask you to give us a like and subscribe to our channel here at Dividend Blasters and share this video with a friend or a family member. Until our next video, have a wonderful day. God bless.